Morning, everybody. It's Wednesday, June 5th. This is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Quickly here, overnight markets had July corn down a half at 442. July soybeans were up 6.5 at 1185.5, and July Chicago wheat was up a penny and 3/4 at 660 even. This morning, ADP released private payroll data. There was 152,000 jobs added in May. That was a miss from the estimate. They were looking for about 175,000, and it was sharply lower than their downward revision of 188,000 that came back for April. We were talking here this morning, guys, just about, we reference a lot of plan A, plan B discussion when we talk in terms of hedging. And these markets, I mean, without stating the obvious, it's a very difficult scenario here right now for a lot of folks based on margins and things of that nature. And so, Dustin, I think, it's probably worth visiting a little bit this morning on just, okay, plan A, obviously we want to rally, we want to sell higher prices. I get that. But for somebody that's maybe just coming into, a new hedging program or starting to think about in those terms, where do you start for a plan B? I mean, what does that even mean to, your average grower? So throw it over to you, bud.
Yeah, thanks, Dan. Well, it's kind of all in the eyes of the beholder, right? If you think about what a plan B really means, it's what's your fallback plan if you don't get the selling price that you want to get to. I think traditionally when a grower says I have a marketing plan, or a banker says I need to see a marketing plan, it's kind of like a written plan of where you intend to sell corn. If it gets up to $5, I'm going to sell X amount, or I'm going to sell, $5.50. That's a traditional plan A, defined selling price that people can stick to. But there's many years where it never gets up to that lofty target that people want to see. And then there's really not a fallback plan. It's like, well, that didn't work out. So, I'm just going to sell it as I deliver, is often what comes about if that's the only plan. So plan B could be just a definition to what your minimum fallback plan is. Sometimes it's insurance. I'm guaranteed for this amount of revenue through October through yield and price. And the plan is I need to be sold by October to have that continuation of that minimum revenue guarantee. For us, it's really kind of defining that with the grower. It could be as simple as going to a third sold, to as complex as, doing some sort of option plan that centers around crop insurance to, kind of relieve the downward pressure of prices until crop insurance is expected to kick in from a revenue standpoint. It's some sort of, average yield that they'd be expecting for the year. Using the matrix, yield and price matrix that we use, and putting all of that data into there, and then defining like what would be a revenue that would cause a major business disruption for the following year, right? If we're going to fall below certain cash flows, or obviously this is a year where margins are quite negative to start, but the difference of losing $300 an acre may be a much bigger problem for somebody than losing $150 an acre. So trying to find that minimum or maximum loss potential, identify that, see what it is that we can do to alleviate that. And then, of course, obviously look for the profitable levels for where we hope to achieve should a rally ensue and give us that opportunity sometime during the season. I wish there was a quick answer for you, Dan, like on what a plan B is. It really is the eye of the beholder, though, because your irrigated grower in Nebraska is going to be much different than your dryland grower, for those types of
well, and Dustin too, like a lot of different crop insurance policies, right? So we recommend a lot of different things, and there's a lot of private products. Some guys have 95% coverage levels, some guys have 75%. So how you hedge around that is a big difference. You don't, and we always look at, trying to be cost effective, efficient with our capital. So, a lot of people end up, from our opinion, looking at it, they get like double coverage in certain areas and have gaps in other areas, right? So like buying a whole bunch of puts at a level where you already have crop insurance, for example, doesn't make sense. But maybe there's a better strategy around that crop insurance to give you that plan B.
Would it be fair to say that that plan B is not limiting yourself on all the tools available, right? I mean, I think that's the really creative route. The plan A is, can be a little more simple in terms of what you use, but that plan B is you got to think outside the box. I mean, is that a fair assessment?
Yeah, it's a good assessment. I mean, it can definitely be more complex than plan A. I will always vouch to say that, there's nothing better for a single bushel of coverage than a futures or a cash sale or HTA. We can go quality to those types of routes for plan A when it's clear that that's a profitable sale. So it's easy for people to say, well, why wouldn't we just sell corn, right? When margins are good, I agree with that. Like, it's just selling corn is your best form of coverage. When you go back to plan B, you lose quality, but you're able to do quantity. So perhaps just like a simple put floor at your maximum loss, on your guaranteed bushels, or a put spread. That costs money, and it's not a very quality trade, because you have to fall down into the money on the puts, and then you have to make money intrinsically on them. And I think a lot of people get discouraged by, that as their form of hedge. But then, when you're talking about how aggressive it is to go get oversold and then get into a 2012 situation or any sort of yield loss situation where markets start going up, it's hard to recoup from being too sold or too sold on futures. So there's a delicate balance there that each grower is going to have to kind of shoulder. And I think that's really our job, is not necessarily telling people where markets are going to go. It's helping them identify, exactly what are you signing up for when you do these things, because these are fairly complex tools, especially when you start talking about the different times of year that you're going to be delivering, and the discovery time periods of when crop insurance is known and not known. That's where things kind of get a little bit muddy, and just simply looking at a matrix is not necessarily self-evident to everybody, where I think the consulting piece comes in and helps people understand how things are going to perform.
That's very good. That's a good conversation there, guys. We'll transition here quickly over into the markets. Ben, we were talking this morning before the show. Wheat's at kind of an interesting inflection point, with all classes kind of bumping up against support levels, as we've started the week here. So maybe just a few thoughts to talk about there.
Yeah, I think the decline is something that on the calendar, we're looking at wheat harvest. I think that'll get kicked off here in the next 10 days to 2 weeks in a lot of places. And we have the roll period coming in. So, I think not surprising that there's been a pretty hefty pullback in the wheat markets. At the same time, there's no material improvement in what's going on in Russia and Eastern Ukraine with their wheat crops. So, I think it's, I think wheat can be a really tricky animal with an early harvest and all the problems that we have out there. We're seeing some different export business coming from across the world. People now are not just sitting on their hands, going hand to mouth, not necessarily US yet. But we have seen some people that have been very comfortable sitting on their hands be a little more aggressive with tenders, because there is a void that's going to have to be filled to a certain degree over the next 3 to 5 months in the wheat market.
It was interesting to see too, Justin. I don't know if you caught this. Also, the Sino grain this morning came out. The story now it's out of China, so whether we can take it at face value or not, but they're talking about increasing their wheat purchases just to continue to build stockpiles. So I thought that was an interesting thing to note. I don't know how that's going to change any classes or balance sheets over here, but they did come out with that this morning.
Yeah, I mean, we've talked about this. I think, obviously the coarse grain, basically wheat, corn, sorghum, balance sheets have tightened, right? So we've traditionally been the last resort when it comes to, buying buying those commodities, especially wheat. But certainly we've gotten very competitive. Ukraine's not a reliable supplier right now. I think we've become competitive there. South America, corn and beans, we'll be competing with them pretty soon. I think they're 5% harvested in the safrinha crop for corn. So we do have some competition for sure in South America, and the real has gotten pummeled recently, so it's making kind of multi-month lows right now. So I think that's also adding to hedge pressure, because that's becoming, those prices are becoming more attractive to the South American grower because of their exchange rate. So we certainly always have competition. But yeah, if you look at the global balance sheet, it's tightening up, so, although we might be losing some business, we're competitive right now, still in corn. That might go away for a period here. But yeah, it's, China buying these things, they've been basically buying everything from Ukraine, anybody that they could besides the US. So either way, they're still buying, to your point, Dan. So, even if China doesn't buy it, that means that's taking away from another buyer, them taking those supplies off their hands. So it's the demand picture is not dismal, in my opinion. I think it looks actually pretty robust.
Across all, is that across all three major commodities, or
yeah,
primarily?
I think more so corn and wheat right now.
Yeah.
Soybeans, the biggest thing going for soybeans is the renewable biodiesel and all the plants that we have going. China's had policy changes, and I think this has all happened since the trade war, in 2016. They've improved their genetics, they've changed their feed ratios to be, less meal intensive, so less hotter ration. All these kinds of things they're trying to be more self-sufficient. So, and their population is declining. So if you look at all those things, I mean, you could easily argue that they've hit peak protein demand for soybeans as far as imports. They're kind of hovering around that 100 million tons, and it might be 97, might be 103. But it's not the aggressive offtake that we've seen, that we saw for the previous, 10 or 15 years, where it's going up by 10 million tons a year. So I think we're seeing beans kind of peak in that area, and the big growth has all been, renewable biodiesel. So, it's good for U.S. farmers. The problem is we've imported billions of pounds of alternative feedstocks, and we've talked about that before too. So
back to undercutting ourselves.
yeah. So I mean, as far as demand goes, if you look at supply growth and demand growth, corn and wheat looks kind of exciting here from that perspective. Soybeans, South America just grows so much every year, and they can expand so much, which also does come into corn to some degree too. But right now, we've talked about this a lot. I mean, right now, I'm just more excited about corn and wheat relative to beans. So it's not saying corn and wheat are going to explode higher and go to these super high prices. It's just that they look like they're supported easier on the downside with demand than beans are right now.
Oh, very good. No, that's good stuff. Got a couple minutes coming into the open here, Ryland. No cash trade has established yet for cattle, and hogs are struggling. So, a couple thoughts here from your desk.
Yeah, and I mean, the focus really has been on the hogs past couple days. The managed money's gotten caught uber long, kind of going into this time frame, and it just seems like we cannot get pork demand really to start to pick up here. There is still a chance to see better weather. We see some better kind of seasonal momentum, but generally, like, you had bellies down $10 yesterday, and cash was lower as well. So you got a lot of headwinds here right now, just on the pork side of the market. It just seems like we're kind of flooded with meat right now, and there's a real concern over, is retail prices gonna, is it retail prices affecting this? So we'll keep our eyes on that. Junes go off the board on the 14th, so typically you can see a little bit of bounce after that time frame. You expect a little bit better of a seasonal. It's kind of similar in the cattle market, where you got kind of a nice little seasonal optimistic potential here just over the next 3 to 4 weeks, but then after that it kind of falls off a cliff. So I think that's what the market's or at least the meat markets are getting concerned about is just that we're already at some pretty high prices on the board. You know, are they sustainable through this time frame? So we'll see. Just waiting for cash to develop on that side of the market. I mean, cash was a little bit lower last week, and you still got this discount between June and the board. So I think there's going to be a narrowing or convergence there at some point. But we got option expirations in June on Friday, and then once again, you got first notice day on Monday. So convergence is likely to happen after that time frame.
Okay, very good. Appreciate that outlook. Just came into the open here. July corn is down a quarter, 442 and a quarter. July soybeans up 7.1186 is the last, and July Chicago wheat is up a quarter at 658 and a half. Tomorrow morning, we will have weekly export sales. They'll be out at 7:30, so we'll visit about that in tomorrow's War Room. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate the thoughts and comments this morning, guys. It was a good conversation. I hope everybody has a great day, and we look forward to talking to you tomorrow.
Thanks, Dan.